Now we move to the next plenary session. Corporate governance has been a subject of very importance and a subject of deep connect for all company secretaries. This brings us to the next plenary session, private equity investment, a governance perspective. The speakers we are blessed with today, I would like to introduce them. Ms. Padmaja Ruparel. Ms. Padmaja Ruparel is an angel investor and president of Indian Angel Network, India's first and now one of Asia's largest group of business angels, comprising the who is who of successful entrepreneurs and dynamic CEOs from India and overseas. She built this organization from inception, which has over 200 investors with a portfolio of 70 plus companies across multiple sectors and geographies. Ms. Padmaja has now established a unique model of an incubator which is based on domain expertise and mentoring value that can be provided to young fledgling incubating companies. This has been established in partnership with Government of India. With a wide range of experience of over 25 years, Ms. Padmaja has been a key player in the entrepreneurship ecosystem of India. She operationalized the TIE Delhi chapter and set it on a sound footing. She has been key in reviving the Indian Venture Capital Association, India's oldest and largest association of venture capital and PE firms, as CEO of the organization. Ms. Padmaja is a key member of the Infinity Innovative Fund team, a rupees 250 crores early stage venture capital fund. We all are very excited to hear from you, Ms. Padmaja. Our next speaker is Mr. Akash Mundrao. Mr. Akash is co-founder of India Secondary Fiduciaries Fund and chairperson at the board of V-Mart Retail Limited. Till recently, he was also global CFO of Naspers FinTech and PayU. As an accomplished professional with a diverse global experience, he has held senior positions at Nokia India Private Limited, Baring Private Equity Partners India, Bharti Airtel Group, AT&T Communications, and as the CFO of Snapdeal. Mr. Akash is a steady member of Institute of Chartered Accountants of India and the Institute of Company Secretaries of India. He holds a bachelor's degree in commerce from SRCC University of Delhi and an MBA from Southern Methodist University, Texas, with Beta Gamma Sigma honors. He has completed a global management program from INSEAD focusing on corporate governance, board chair, and sustainability. He recently completed making corporate boards more effective from Harvard Business School. We are very excited to hear from you, Mr. Akash. And last but not the least, we have the speaker, Mr. Kailash Adhikari. Mr. Kailash is a double postgraduate in accounting from London School of Economics and an ex-Government of India official having experience of working with Planning Commission of India. He is Managing Director of Governance Now and sub-events. He is responsible for creating new verticals for the publication business, namely digital vertical and capacity building seminars. Governance Now PSU IT Casebook was recently unveiled by Honorable Prime Minister of India, Shri Narendra Modi. Mr. Kailash is an alumni of Jamnabai Nursi School and Nursi Monji College, and he has won several accolades for the school and college debates, elocution, and several other forms of literary arts competition. A ferocious poet and writer, he has written several pieces of literature. I would now hand over the charge to Mr. Adhikari. Thank you.
Hello. Thank you so much. Good afternoon, everyone. And once again, thanks to Institute of Company Secretaries of India for having us all over here to discuss a very pertinent issue. We are right after the lunch, so we'll try our best to keep the spirits high. We are here to discuss a very important issue of private equity investment and governance perspective. So once I welcome Ms. Padmaja Ruparel to the panel and Mr. Akash Mundra. If you look at the Indian context and the economic growth of India, much about of that has come in, that has propelled from foreign direct investment. And a larger chunk of that has come through the private equity. In 2023 alone, Indian private equity and venture capital fund that has come is about $39 billion, although it is a sharp decline from 2022, it is about 35%. Now, if we track and if we spend a minute on the history of private equity investments in the West, when it started in the United States or in the United Kingdom, typically the instrument has been particularly used to invest in a company, grow that company along with the founders with a professional approach, and then the exit happens either through an IPO or selling it to a strategic buyer. The most preferred route has been of a leveraged buyout. But if you see in an Indian context, the difference is that in an Indian context, most of the companies are family driven or are promoter driven. And in that case, most of the private equity investment that has come in, according to a Bain report, is also in a minority stake. And there stems the question of corporate governance perspective, because it is largely believed that, the functioning of an Indian company, whether it's promoter owned, is typically, it is depending upon how they drive a particular business. They actually look to a private equity as a passive investor, whereas the expectations of a private equity firm could be of not just putting in money or just being a capital force, but also an active participation in the day-to-day affairs of the business with the aim to drive the business ahead. And here is where sometimes a conflict comes. Whereas if you're holding a minority stake when it comes to a private equity, then how are you comfortable on the corporate governance perspective? How do you assure that the money that is being invested and the management is in the hands of the right people? When investing in a particular company, naturally, any firm, a private equity or a venture capitalist, will look at whether it's the right valuation, what is the actual asset value there, and how even a dollar plowed in will actually reap returns. And there where all the questions are. So we'll take forward this panel to discuss various issues that surround private equity investment, about how they are done, what is the governance perspective, and how one can actually find a bridge. So my first question to you will be to Padmaja ma'am, looking at your experience, how do you feel that, when a private equity firm is trying to invest in a particular company, what are the do's and the don'ts for them? Or what are actually the tick marks that, yes, what are the criteria that they actually look at before investing in a particular company?
So thank you, Kailash. At the very outset, I'd like to thank ICSI Middle East. I think thank you very much for inviting me here. And clearly, there's a lot happening here, which we from India don't really get a glimpse. So very happy to be here, Lakshmanan. Thank you for inviting me here. Before I actually respond to your question, I want to share that, we always have a very different view about CAs and company secretaries. But when we start investing and we get down to diligencing companies, I think company secretaries play a huge role. We don't realize that, but there's a huge role that they play. So I just want to use this platform to say thank you to a lot of you, what you do. To your question, I think two things before we sort of answer that. Today, if you look at Indian publicly listed companies, 65% of them do have private equity sitting with them. You have VCs, you have private equity, growth stage money, and you have late stage private equity. So India is moving into a scenario where unlisted money, if I may say that, which means money invested when the companies are unlisted, right, is really breeding some of the innovation, some of the large scale-up technology or technology-enabled companies. So there clearly is something that early stage, late stage VCs, private equity are doing. So that's number one, and that also endorses the kind of investments that these funds do because they finally get listed. And when they get listed, the whole process of governance and diligence, etc. So I think that is something I'd like to share. Having said that, I particularly, I'm an early stage investor. I'm not a private equity investor, so I can probably talk more from that lens. For us, we come in when companies are startups. They are very early stage. They just started, let's say, a couple of million of revenue at best. So we come in when they are raising about from $30,000 to about 8 million. That's our range because we have about 500-600 angel investors investing with us. We have 2 VC funds. So that's what we do. Now, when we look at it, we probably look at 3 or 4 things. We invest in companies that are solving real problems. And India does have a lot of real problems like water, agriculture, cyber, a lot of real problems we have. So we look at companies which are solving real problems in an innovative way. We are not an investor which looks at one more device or, for that matter, with all respect, luxury products. That's not who we are. We believe number 2 is that there are companies which are building top line and bottom line. In Hindi, we call it dhanda without munafa doesn't work for us. There has to be a profit. Ultimately, it should be moving towards a profit line. Number 3, I think we are very, very conscious of capital efficiency and unit economics. So we do look for the thinking, how they've structured it, how they're measuring, how their parameters going. So we do look at the left side of the expense statement. We believe that young startups don't understand the numbers, they get it wrong, but have they done enough deep thinking? Number 4 is that because as any equity investor, we look at increase in the share price, scale becomes very important for us, right? So for scale, technology becomes absolutely imperative. So either technology is at the center of it or it's technology enabled. All of these 4 things, to me, we give a weightage. In my personal lens, I give only 30% weightage to that diligence. 70% weightage at our level is on those 2 co-founders. We are laying our bets on those 2 horses. If they are not good, if we feel they don't have the passion, they don't have the leadership skills, they don't have the understanding of what they need to do, and they don't have an understanding of what they don't know, that's a problem for us. So 70% weightage is on the founders. So a long answer to your short question, but those are the 5 things with broadly that weightage.
Thank you, Padma ma'am. And I can actually echo what you said is about a long time ago, a banker told me, and it's about banker also invest, even though it is debt, but at the end of the day, it is investing. That is also an investment. And he told me that, and in Hindi, he told me that बैंक भी जब देती है तब इंसान को देख के देखती है. So that is where your 70% lies, that at the end of the day, if we know that the person driving the business has that in or him or her, then naturally that will have to succeed at one day or the other. You raised also a very pertinent issue, which now I'll drive it to Akash. It's about professionals such as company secretary and chartered accountants. They are the torch bearers, or I can say the gatekeepers, the first initial torch bearers for any other investor coming in. When you have a company which is completely aligned or where there are strong fundamentals with regards to corporate governance, and when you know that the chartered accountants and then the company secretaries, they are like the torch bearers of good corporate governance here. Akash, I'd like to understand from you that, for a lot of Indian companies which are family driven, private equity money or private equity investments actually help them drive growth. We have seen cases where actually businesses have expanded to another level, and wherein the promoters have also cashed out, even the private equity investors have cashed out well. What perception of PE firms do you believe such companies or promoters carry? And how do they see a private equity investment coming into their firm?
Very low. Am I very loud? I'm getting a lot of echo.
Yeah, I think this.
Hello. Hello. Yeah, I think this is better. Yeah. Well, I didn't mean to scare all of you. My voice was like just too loud. Maybe it was because to wake all of you up after lunch. Look, thanks for the question. Before that, I just want to say thank you to ICSI. Very indebted, honored to be here. And I'm personally a company secretary as well, qualified in 1997, I think. And the second thing which I will relate to your question, and with an example before I go to the family office part of it. So this is a real life example from a company called Snapdeal. I was there from 2011 to 2015. I was the CFO there. This is valuation from 200 million to 5.2 billion, and then I had left. But I had a company secretary called Manish Kumar. And that guy basically helped me do 7 different rounds of fundraising. We raised $1.5 billion in 7 fundraisers, and there were all sorts of law firms. But this company secretary had so much knowledge that I would probably have a lot of confidence on him, and he's saying, hey, this term doesn't look right, or this term looks right, etc., etc. So we all can do a lot if we decide to, and this profession offers you an opportunity to do it. So that's on company secretary. And Manish is, by the way, still in touch with me since 2015, and we keep exchanging notes. And he's now a general counsel of a large company. On the question of what founders think about, or family offices think about private equity money, I think it's like any other thing in life, right? It's almost like a marriage. If I see value in what private equity bring to the table, then I am going to embrace it wholeheartedly. But if I don't see value in what they bring to the table, then I'm not going to embrace it. And yes, there are certain things which are common for all. So for example, when I raise capital, I will be able to grow the company faster. I can invest in different products and services, etc., etc. But how is the marriage going to be? And I think that part is extremely important when it comes to family offices in India. What they see is, can I deal with this person for the next 10 years sitting alongside me? And do they see that this person brings value in my business? I think that is very important. I'll take a real life example. This is, I feel really, really proud of this. I joined a board of a company in 2009-10 called V-Mart in India. V for Victory, V-Mart Retail. The founder is, basically it was a family run business. Founder Lalit Agarwal with his father and his younger brother. And Aditya Birla Private Equity invested into that company. He took money from Aditya Birla Private Equity. The company had 20 stores and the revenue was 80 crores. 20 stores and 80 crores. Now, today, that company has 3,000 crores of revenue, 500 stores, and we actually last year went to London together to receive a Golden Peacock Award for corporate governance in mid-size segment. Why did all this happen? Because this is an outcome. Why did all this happen? The first 5 years when private equity was there, the founder and the private equity guys had an alignment of interest. You say, we are both on the same side of the table. You will also grow, we will also grow. The industry went through a tough phase. The founder decided to honor all the commitments that he had made to the private equity guys. He said, okay, I promised you an IRR of so much, we will do this. But more importantly, there were positions like there will be 2 independent directors on the board. And that's when I was brought on board. And since then, we've followed all the practices. And today, that founder actually thanks the board so much. And this is still a family-run business. It is considered still a family-run business. But the founder just thanks so much for what private equity did to him. So I think it's important. It's a marriage. before the marriage in the prenup agreement. Prenup agreement, outside of what capital provides, the do's and don'ts of do I like to talk to this person or not is very important. The way the person talks, can I have a dinner with this person? Can I share? Because it's very lonely. For the founder, it's very lonely. Can I share my problems with this investor, and will this investor value what I'm saying? Will the investor listen and not boast? Right? That's the other side of it. All the investors think, and I've been an investor myself, all the investors think that we know everything. Sometimes that's the impression that people give. So you have to be listening and understanding the challenges that a founder goes through. If you do that, then I think it's the best combination possible.
Very rightly said, it's about a marriage, where a marriage and a lot of factors of understanding, adjustment, and knowing each other, comes in that. Akash, you mentioned about the fact that your experience of professionally, you being a company secretary, then you gave a certain experience. My next question will also be to you, then I'll come to Padmaja ma'am. It's about, how can a company secretary at his or her level, being, as I said in the beginning, the torchbearer of corporate governance, mitigate any concern that a PE firm might have? How can a CS be actually the catalyst for driving investment into a company?
So I'll take another example from a portfolio company, right? This company was private earlier and then went public, and we had hired a fresh company secretary, I think maybe 2 years of experience. And she is still with the company the last 15 years, and she's grown with the company. I think to your question, there has to be first of all, I think it's the responsibility of the team as well to provide an environment to the company secretary. But I think the right from small things of board meeting finishes within 48 hours are the minutes being circulated. Within 7 days of the minutes being circulated, are you getting the comments? If the board members are not responding to the comments, are you politely following up saying, we have to finalize the minutes of the board meeting? Can you please send your comments? And people love this. I just gave one example. The other example that we have is every time there is a change in regulation or anything that happens, company secretary actually informs the entire board saying, this is what has happened, this is the implication for the company, this is the implication for you, etc., etc. So a lot of proactive engagement, which makes, of course, they have the knowledge, but which makes people around them also feel that, hey, there is a lot of value add from this. And then, of course, I'm not going into the details of shareholders agreements, this, that, but just keeping everybody honest from a governance standpoint is a company secretary's role. And you have to learn to do it appropriately, because sometimes people can say, who are you, right? You are one small person in this leadership team meeting, but you have to make your presence felt in a very polite and a diplomatic manner where people actually think that you are valuable.
I absolutely agree, Akash, since I'm also a managing director of a public listed company. And the way we conduct our board meetings, where I have an independent board of director who himself is a PhD in corporate governance. And I like to empower my company secretary that, you drive the board meeting and the AGM. Where I am required to give my statement, that is a separate issue. But I always prefer my company secretary to actually drive the board meeting and the AGM. And the fact that empowering a particular professional will not only help you in the long run in setting the benchmarks and the standards right, but will also give a very true picture and a balanced picture of your organization and how good or bad is the management. Now, Padmaja, my question to you is, private equity investment is considered to be of a considerable size. When a private equity comes into a company, there is a certain threshold or there's a certain size that comes into it. is it always true, or can we just believe that, if a company has reached a particular size in terms of, you can call it revenues or however the balance sheet size is, that means, okay, it is a good enough tick mark for a private equity to come in, and we can safely assume that, corporate governance standards are met. Can size be the only or a deciding criteria?
Kailash, I wish I could say yes, of course, but it's not. That's the reality. So I think size is not important here, right? I think it's the quality of the people, the quality of the system, the quality of the processes, quality of the thinking, of governance, of value. I think that matters. So when, irrespective of whether you are on a listed or an unlisted company, I think these things matter to my mind. And that governance has to be driven from the top, because it's the guy at the top who's going to actually detail it down to the last nth level, because his job, whether it's chairperson's job, is to really drive governance. I think governance and culture sit right at the top. There's no other way that it can happen, right? And you have companies which are very large with sizable checks where governance becomes an issue. Now, some of us know those names also, so I'll not repeat it. But again, governance is not relegated, I want to be fair, is not only due to failure or success of the entrepreneur or the founder, right? I think governance is a part of the entire stakeholder community, especially investors, especially board directors, and of course the founder community and the key people, key management committee. Even in small companies, we find this. I'll give you two examples, right? We were an investor in a very small company with 2.5 crores. Okay. Behind us, they raised 70 crores from two rounds from two VCs, right? Now, when the VCs came, their philosophy was to keep pushing the revenues, forgetting about something called costs and something called profit line, right? I still remember this was a Chennai-based company. I had gone to Chennai for some reason. And I said, Acha, Chennai aaye hain, let me just take a walk. And when I walked into that office, I was shocked. Because when the founder had first come to pitch to us, when he was raising 2.5 crores, his shirt was out. He was wearing chappals. He was doing a pitch in an IBM office in Bangalore, right? And I was telling him before he went into pitch, put your shirt in, right? At least do something. So, and when I went into that office that day, the receptionist, they had about 200 people, which we knew the numbers, but the receptionist was sitting with a Mac. Okay, that's a very, very big indication that capital efficiency has for sure gone out of the window, right? And I came back next day and we called a meeting of the key investors and I told them this was my observation. And I still remember Mr. Munjal, Sunil Munjal, he was an investor and he called me and he said, I think you need to start moving towards exit from this company. It so happened that the company started sliding before we could blink an eye. Okay. And by then we got Vesh Associates to partner with us. We got 18x net of tax returns out for our investors, and the VCs lost completely their capital. Okay. And they lost 2 months after we exited. Right? So governance comes at every level, and governance demonstrates itself at every level. It doesn't mean that there is some document that is not complied with, some report that has not been filed, some note in the audit report. Those are all comes at a much later stage. It comes much, much earlier, right? I'll give you a second example. There was an entrepreneur who came in. There were two entrepreneurs. One came same day. They both came same day. They came to us to raise money. We gave a term sheet to one guy, okay? And he was sitting in the office, and we told him, would you like some lunch? No, ma'am. We'll have dosas outside, right? And we said, why? He says, ma'am, you'll spend $400 for my dosa. You know, Swiggy ka cost itna hai. This is the cost of the dosa. This is the delivery cost. This is the GST cost. So he was doing some math, and it was not the dosa that was important. The fact that we did get him a dosa, that's a different issue. But he was doing some calculations. That evinces a lot of confidence in everybody, including the investor, right? Now, we gave him the money. The story is very, very interesting. In fact, there's a book written on this guy. Okay. He was if I can take a minute, his product was a waterless robotic solar panel cleaner. March of 2020, his till date revenues were 1.8 lakhs. Lockdown happened, India went through a tough lockdown. That company we actually converted in 95 days to a smart ventilator. Okay, we had 20 people sitting around a Zoom call for 2 hours each day, 7 days a week. We ऐसे ही घर पे बैठे थे, क्या करने वाले थे? So we converted this company. We got components, we got equipment, we got approvals from Taiwan, Germany, Singapore. We got one component on the last flight, Air India flight out of Singapore before Singapore went into lockdown. July of 21, revenues were 79 crores. Okay. It was an unfortunate situation because India was hit by a second wave of COVID and all the rest of it. But it's the entrepreneur grabbed it, right? Now, remember, there was a second entrepreneur from Bangalore, tech company, doing something very interesting. He took the term sheet. He left for the airport. Unfortunately, one of my team members also went to Bangalore on the same flight. He called me. He says, ma'am, the guy is sitting in business class. I'm sitting in economy. What do you want to do? I said, we'll cancel the term sheet. That is governance to me. You have to be alert at every level because it showcases the thinking. It showcases the value system. You don't want luxury happening on someone else's money, right? So I think be it founders, be it key team members, and even investors can kill a company. Let's be very, very honest. I'm an investor. I think we have enough examples to say it's the wrong push, and founders get stressed on this. If I'm telling him, if he has projected that I'm going to do 5x, and I as an investor say that no, you have to do 20x, he is one step short of a heart attack. वो करेगा तो क्या करेगा? He can only focus on the top line. He cannot focus on the bottom line. Let's be very clear on that. And that, I think, is a failure of governance. That's a failure of value system in investors. So I think we cannot say that we are demigods on one side of the table as investors. No, we are partners in crime and we are partners in success. So I think that is, to me, governance, that together we have to build it together. And I think the person who, as Akash said, I just want to add one point to what you said, Akash. The CS is very important because how he presents those minutes becomes very important. Is he representing the founders and then minuting the board meeting, or is he representing all the board members and then minuting the meeting? They're two very different issues, right? So I think these are things that we sometimes don't look at. And I think it has killed us. In some companies, we have suffered because of it. And in some companies, we've been saved by a sliver.
Sure.
Sorry, I think there are three different perspectives also here, which I wanted to add. And I went to Harvard Business School last year, and there was a course on making corporate boards more effective. And the first day, we did cases where governance had gone completely for a toss. And unfortunately, we are also living in a world where shareholder returns versus stakeholder returns, and everybody is focused on shareholder returns. This is like large corporations, not family offices, but large listed corporations in the US, where everybody knows that governance has gone for a toss, but the company's stock keeps going up because of performance. So some of these challenges you will face, and I'm not here to say what is right, what is wrong, but you will have to figure out where your heart lies and what you should be doing, because this whole capitalism model also is questionable, but that's a different thing. The reason I mentioned this is it's not just family owned companies where governance is an issue. Governance is universal, right? That's the second thing that I wanted to say was in family owned businesses, sometimes you see much higher governance. If the person on the top or founders say that, hey, look, we are not going to do anything which does not feel right. Right? That's the second part. And so if there are two companies, everything else being equal, I like these lines because somebody taught me in economics saying law of demand and supply, everything else being equal. So similarly here, everything else being equal, companies with higher governance do get a higher premium, right? And the third perspective, which I learned, one of my mentors is actually sitting in the audience here, Subbu, who's going to talk in the next session. Sometimes governance also presents an opportunity to make an investment. Subbu can talk more about it, but I'll just say two lines. When governance is not right, and when you invest in the company, but the business is right, and you have the potential to change the leadership, it is called as governance arbitrage. And Subbu, from 1999, when they invested in BFL Software and Emphasis, etc., that investment itself, I think, returned about 10x. On a 30 million investment, I think the return was 300 million. And it was one of the best performing investments that was done. So that's a completely different perspective where I am going to find companies where there is governance arbitrage, where I'm going to change the management. I like the business. I will take control and I will build the business. So that's a different perspective.
Very well said. And Padmaja ma'am, you gave a very good example of two companies about the term sheets. I recollect talking with a founder who was very candid about, what went wrong with him. He started off very promisingly. He got good amount of capital invested. At one point of time, the business failed, everything failed. And once I was having a chat with him formally, and I'm like, if you introspect, what went wrong? Galti kiski? What went wrong and why? And he very rightly said that sometimes what happens that I had money coming in. I had a dream. I projected. I had about, let's say, 500 to 1,000 crores in my bank account. I didn't know what to do. You invest in taking on lease the entire floor of a WeWork. You take about 4,000 square feet of office. You mentioned about the Mac at the reception. Sometimes maybe the intent is not wrong, but the execution goes wrong. And that's where any VC or private equity or angel investor is there, that after investing, do they have to say silent for some time ki chalo ab dekhte hai, how does he do? How does she do? What is the proactiveness that is needed? Because in his case, the intent was not wrong. I could make out in that interview. I interviewed him. But deployment went wrong. Not that he siphoned off also. That was also not the case. But he did not know what to do. It's like suddenly you get something which you're not dreaming of, you get it, and then you splurge it in not on your personal self, but in businesses where you don't even think that you should go. And somewhere that guidance did not come in from the people who invested. What is your take on it?
No, I get it. We see this all the time, actually. So we invest in early stage companies where actually there's no history. There's no data, there's no trends, there's nothing there when we invest. So for us, it's a very, very difficult diligence, if I may use the word, because we are basically diligencing the future which is yet to unfold, right? That's what we do, not only as equity investors, but as startup equity investors. Unlike debt looks at the history of the company. We look at the future of the company. That's the difference. Now, what happens is, till then, by the time we come in, the entrepreneur has got done some revenues. Okay, uska revenues, what is it? They may have sold one or two products, right? Or they may have done some consulting business and got some money. Now they are running the company depending on wherever the money is required. Today the rent has to be paid, so they'll pay rent. Tomorrow their house rent has to be paid. They have to pay the house rent because they are full time. So they are just struggling and meeting immediate costs. That's where they are when we invest. Now, when we come, I think one of the things that early stage, specifically very early stage investors, or even till Series B investors, we also have to assume the role of actually grooming the investors, disciplining them, explaining to them what systems, what frameworks, guiding them into building a robust governance system. Right? You almost start by saying that you need to do board meetings. A board is comprised of these three people. This is the role of the board member. This is when the minutes have to come out. We have to give them a compliance sheet. Right? We will not do a board meeting till they don't sign off on the compliance certificate. We have to go down to that level. Right? How do you set up an ESOP trust? Okay, we have a company, they were raising a bridge next round with us. Everything was done. And then finally, when we said, now are you ready to issue the shares? We are going to remit the money. The CS gets up and says, yeah, we can issue the shares, but we don't have enough in the authorized cap table. I said, "Arey, so why didn't you start earlier?" Because that person was very junior. They cannot afford a person who's experienced. So the role of the investor is extremely important. The intent at all is not in question. It's just a lack of knowledge, lack of understanding. Why is it required? Why do I need to do all these things? Right? Why should I have authority levels? Why should I have joint signatories? Right? All of these things, and they don't believe. Initially, this is my baitha hu na. What's your problem? If a bus hits you, what does the company do? This is no problem. Someone else will take over. Who's that someone else? You have 20 people you're paying. Their families are involved. There'll be no money going to their families. We can write off our capital, but so you have to start instilling these very, very critical basic values. And then as the company grows, you have to start teaching them about debt equity ratio. Don't take too much debt. You should have a cash flow. We tell our companies every morning your cash balance should be on your WhatsApp. Right? Because you don't know when you're going to run. If you are not instilling that today, when it becomes a 5,000 crore company, you should still have that on your dashboard on your phone. Because that's the only thing that matters. Actually, the rest is all, with all respect, is all an accountant's game. It is only that cash in, cash out, and cash balance. That's all that matters. So all of these things, I think, to a great extent, we have to instill in them. Now, that is when the intent also shows up. When you see that it's not getting followed, you see that there are many, I'm telling you this has happened. Okay, the guy says you're allowed to, we said we've approved 3 lakhs per month of salary. Okay, no problems. So there is a 3 lakh salary check going out. Then there is a car expense of 50,000 going out. Then there is a mobile expense of 20,000 going out. Then you see, that's when you start seeing a trend. And that's when you start becoming alert. So, that is what I think is where the intent starts to move. And that is very seminal, because as the company grows, that movement will be 180 degrees.
Absolutely.
Can be, I should say.
And you rightly said that, as an entrepreneur or as a founder of a particular business, my thing to my CFO is always every night at 9 p.m. I should have on my WhatsApp my cash balance, the ins, the data collection, and the vendor payments, and what is my cash balance, because cash is king at the end of the day. Now you have a bright young audience here, all company secretaries and professionals and chartered accountants. They have a certain perspective on private equity and corporate governance since they deal with it day in and day out. We love our all enlightened audience to have some questions or discussions that they have for this particular panel. Would be lovely to have your questions and views.
One way to keep it away.
Does anyone have a question here? Yes, ma'am. Can we have the mic to her, please?
At least one person is awake in the crowd.
I think the mic is not working.
Yeah, am I audible?
Yes.
Yes, so you have raised a very interesting point of governance arbitrage.
Speak a bit louder.
You have raised a very interesting point on governance arbitrage. So we as practicing professionals, how we can help the investors in, bringing this governance arbitrage in the companies.
So I'm going to rephrase the question so that I got it right. I think we as company secretaries and people in profession, how can we get, let's say, corporate governance arbitrage for a particular company, right?
Through the investors. So sitting as an investor, sitting on behalf of the investor, not from the side of the corporate.
So you are representing investor or company?
Yes, investor.
Or representing the investor?
Investor,
Yeah.
yes.
Go for it.
No, I think the last answer that Padmaja gave, right, which is about, and to be honest, when you are a founder and when you are a startup, you don't have so much money also that you can hire a company secretary. You have 25 different things that you need to do. And so this one will come saying, okay, once I get to a certain size, a certain scale, then I will hire first a CFO. That is also not available. So I will hire a CFO, then I will come to company secretary, etc. And that's exactly where there is an opportunity. So if you are an investor and if you have 10 different companies, you can actually hire a professional company secretary or a governance specialist and start offering your services to these companies, right, which you are invested in. Now, again, a word of caution here, which is you have to be very careful in this. Depending on the stage and size of the company, you might be able to add value into the company, and yes, you have a governance specialist, etc. But in the pecking order of the size and stage of the company, are they dealing with bigger problems? If they are dealing with bigger problems, and then you, as an investor, go and tell, saying, "Hey, I'm here to fix governance," and the founder will say, "Go take a walk," right? Because I have bigger problems to solve right now. But slowly over a period of time, as the company scales and as the founder starts seeing the benefit, so it's almost like trickling in. And then once the company reaches a certain stage, then obviously you can have full-blown governance mechanism. That's how you build the arbitrage as an investor.
I just want to add, and I want to actually take off from where Akash brought up this governance arbitrage concept. I think it's a very, very well articulated concept. So, so what is governance arbitrage? The way Akash earlier recommended is that we like the business, but we don't like the management or the founders, right? So you want to change the people, not the business. If that is the case, I think the role of the CS is extremely, extremely important, right? Because there is a business decision that has been taken by the investors to say ABC people have to be moved out. Now, remember, these ABC people are key people. They could be shareholders, they could be ESOP holders, there'll be signatories, there'll be all of those things will be there, right? And the new people who may come in, who the investor may bring in, may not necessarily replace these people in all these attributes. They may not have the same shareholding. They may not have the same ESOP. They may not have the same authorities for some business reason, right? Now, as you make this transition from the old team to the new team, a strategy has to be drawn up. What will change first? Will first the signatures get changed? Next, what happens to the shareholding? What happens to the board composition? What happens to the ESOP? If the ESOPs are not going, where will the shares go and sit? I'm just giving you different examples, right? If the unvested shares of the founders are going to be held back, where will they go? I mean, there are hundreds and hundreds of questions. I think the role of the CS there becomes very important to help draw up that strategy of operationalizing the business decision that Akash talked about, right? Because here it is not a question of removing people and getting new people. Here there is a whole long tail of other statutory company law issues, share issues, ESOP issues, banking changes. People may have taken debt guys would have certain conditions. So I think the role of the CS is to actually look at all of those things, draw up the right sequence of actions that can be taken to operationalize that transition. And yes, of course, it will have to be done in conjunction with various tax advisors, with CAs, with legal guys, etc. But I think here the pivotal role of all of this, there is a very critical role for CS in this transition.
And maybe just one more point, and this is a concept that I want you guys to just be with. So I was a part of the NASPERS group, and we had multiple investments. We actually had to go through a code of conduct training. Board meeting, what is the responsibility of the board? It is not a shareholder meeting. So if there is an investor sitting on the board, he cannot behave as a shareholder. He has to think about the best interests of the company. Second, if we have competing investments, for example, I have invested in fintech, which is into lending business, and there is another fintech which is also in the lending business, then I will not be, if I am the supreme authority in the company, I will not be sitting on the two boards. I will not have access to information of the other company if I am sitting on the board of this company. So there is a lot of role that company secretaries can play with the investors as far as educating their own investors when they sit on the boards and their own internal teams. What information can be shared with whom and what governance principles to be followed. That's another big role, which gets discounted very quickly, but something to think about.
Thank you so much. I think we'll take the last question of the gentleman here.
Thank you. Very enlightening discussion. I have two questions. One is, how would you look at founders who are doing multiple gigs?
We're doing?
So-called serial entrepreneurs having a couple of gigs around, running around and raising funds. How do you look at it from a governance perspective? And more importantly, have there been positives and negatives from your experience? Second question is, we see entrepreneurs sitting in Dubai, in our offices, people who have come with a mandate that, you need to have another destination to their startup, Dubai or a UAE destination. Obviously, from a valuation perspective, I guess it makes a difference according to them. How do you look at it from a governance perspective as an investor, when that is the attitude of a founder, that you want to have just another place as an address, whether they actually do business or not, and looking at it from a valuation perspective?
Second question. I can rephrase the second question for you. So the second question was founder sitting in India wanting an alternative address in Dubai and opens an office in Dubai, but may not have any business in Dubai. How do you see that from a governance perspective?
Okay, so let me try. So it's a tough question here. So if there are entrepreneurs doing multiple gigs, I don't look at him or her for that matter. I want to invest in a company where the founder is focused on what he's on one company. 110% of his time is there, right? It is life and death for him. Only then will I invest. However, now comes the piece. However, we have seen and we have invested in companies where the founder has been involved in two companies, right? One, because he had started with his dad or his brother, the other, which he started on his own. Then we go down the diligence side and we say, how much time is he spending there? If he's just going to hold shares in his dad's company, purely because his dad wants to give the shares, he's not putting in any executive time, he's not involved in any board seat, he's not involved in any decision making, we start looking at that kind of piece. But therefore, he still puts in 110% of his time on the main business. It's just like one more asset that that entrepreneur may have. That's how we would look at it. Unless if it's more than one financial asset concept in the other company, then it's a no from us. So that's one very clear thing we do. The second piece which you asked, I think we actually don't want to invest in entrepreneurs who are in two locations, just if they're not required from the business perspective. If they have to be if they are an Indian company, they have to be in Dubai for a business reason. They are doing some revenues here. They have some development here. They have some operations. Fair game. That's okay. But just because you have an address here or you have a company that they open that in future we'll open it up, doesn't work. In fact, right now, I have a situation where an Indian company wants to open a subsidiary. What do you want to do with it? Why do you want that subsidiary? Why do you need it today? No answers. No. One day what we'll do is we will take the IP, put it in the subsidiary, and we will sell it off. One day, let that one day come. Let's see a glimpse of that one day. So in an Indian company with an Indian subsidiary, we don't think it's a waste of time. It's a distraction. It's a cost that you don't need. When you do all this, there's a legal cost, there's a tax cost, all of that. We don't want that. But on the other hand, this other company which we have, which is a company which is taking flower waste and converting it into personal oils, and it's converting into incense, and it's doing enormously well. It has created alternate to leather. They call it leather because it's from flowers, right? Now, alternate to leather has a huge market outside of the India. So we are actually encouraging him to create an US company, because that product will bring revenues from there. So I think it's completely, I think it's a very, very transparent decision-making from our, is it useful to the business? Is it going to add value to the business in which we are investing? We will work with the entrepreneur. But if it's not, then we don't want it.
I know time is running out, but I want to give a contrary perspective to what she said on both the fronts. On the first front, which is people doing other businesses while they are founders in one company. It's easier said than done to say, I am not going to give money to this person, because we are living in a hardcore capitalist world. And there are at least 100 people that I can name right now if I start rattling, where they have their VC funds of their own, they are running their company, they are chairing another company, and they've become demigods, by the way. If you go on LinkedIn and you see any post that they make, there are 20,000 kids who like it. So this is the harsh reality. There is no right or wrong answer here. You have to figure out what works. But it's not easy to say point blank no to people who are successful, right? That's one. Second, to having the location. I still think it's a case by case basis for a reason. And I'm happy to name the person, Prashant Ranganathan, my colleague at PayU. We acquired his company from India, founder of that company. We acquired for 170 million that company. He was based in India. COVID happened and he said, I am going to move to Dubai, right? He had no reason to move to Dubai, but he moved to Dubai. We allowed him the move to Dubai. But whenever he was needed to be with the business, including 14 days of quarantine every time he would travel to India, because he had to balance his family. He also had a wife and 2 kids, and he said, I can't risk them. I have earned the money, so I want to take them out, but I will keep shuttling and take all the pain. He created a $1 billion company. So there is no, I don't know if there is a right answer to that. So I'm giving the other perspective as well. So please look at the details behind the case and not just yes or a no.
Yeah, I agree with you on both your points. But I think my comments were coming in from the stage of investment that we do. Okay, at a startup level, at an early stage level, there we would need to insist. We can't have a guy who's raising 3 million and going and doing investments and going and doing something else. That doesn't happen. But once it becomes a 300 million, then it's a very different game. Because by then, and I'll give you the reason why, because by then he would have got a key management team there, right? Which is driving the operation, the executions are in place, governance is, everything is sort of rolling. So I'm talking, so there, I should have probably said that, but I'm talking about from the perspective that we come in, at the stage we come in.
We started debating here.
No, thank you to you, and thank you to the lovely audience here. I think we had a very good discussion. Thanks to Padmaja, ma'am, thanks to Akash, and thanks to the lovely audience here. Thanks once again to Institute of Company Secretaries of India for having all of us here and having this Middle East conference, and especially our theme. The theme has changed, but ours is private equity investment, governance perspective, and responsible investment for sustainable future. And once again, thank you to everyone, and over to you. Yes.
Debate could have gone on for a longer time. I thank Ms. Padmaja and Mr. Kailash for appreciating and highlighting the role of company secretaries. We promise from our side that wherever a company secretary will be, there will be good governance. I would request Mr. Vinod to come on the stage and felicitate the speakers for the today's session. Mr. Vinod.
Akash wants to say something.
There is a general trend that I see, which is as soon as speakers get off from the stage, people start coming and giving visiting cards. This is a conference related to sustainability. I am on LinkedIn. There is only one Akash Mundra. Just mention your name, mention the details that you met me or saw me here, and I will connect with you. So no need for business cards here.
Akash ke cards khatam ho gaye.
So, Mr. Vinod, can you come on the stage, please? Okay. In paucity of time, I would request Mr. Vijay ji to come on the stage and felicitate today's speakers. Mr. Vijay Ojha is the director and founding committee member of ICSI Middle East DIFC NPIO. Yeah. Padmaja, Miss Padmaja Ruparel. Miss Padmaja. Mr. Akash Mundra. Mr. Kailash Adhikari. Thank you. Thank you, everyone.